Hello, everyone. Welcome back to our channel. In today's video, we'll be discussing two primary methods through which companies raise capital from the public. 1. IPOs and 2. FPOs. Understanding the difference between an initial public offering, IPO, and a follow-on public offering, FPO, is essential for investors. So, let's start without wasting any time. When a company decides to go public and offer its shares to the public, it can choose between an IPO or an FPO. Let's start by understanding what each of these terms means. An IPO, or initial public offering, is the first sale of a company's shares to the public. It occurs when a private company decides to become a publicly traded entity. During an IPO, the company issues new shares and offers them to investors, typically through an underwriting process facilitated by investment banks. On the other hand, an FPO, or follow-on public offering, happens when a company that is already listed on the stock exchange decides to raise additional capital by issuing and selling more shares to the public. Unlike an IPO, where new shares are issued, an FPO involves the sale of existing shares held by the company or its shareholders. Now that we understand the basic definitions, let's compare the key differences between an IPO and an FPO. Difference 1. Company status. An IPO occurs when a private company decides to go public for the first time, making its initial entry into the stock market. Conversely, an FPO takes place when an already publicly listed company seeks to raise additional capital by issuing more shares. Difference 2. Purpose. The purpose of an IPO is to raise capital for the company's growth, expansion, and other strategic initiatives. It provides an opportunity for the company to access public funds and allows investors to become shareholders of the company. In contrast, an FPO is primarily aimed at raising additional capital for various reasons, such as debt repayment, acquisitions, or financing future projects. Difference 3. Share issuance. During an IPO, the company issues new shares and sells them directly to the public. The proceeds from the sale go to the company. On the other hand, in an FPO, the company or existing shareholders sell their existing shares to the public, and the proceeds go to the respective sellers, not the company itself. Difference 4. Market impact. An IPO is often accompanied by significant market attention and hype as it marks the company's entry into the stock market. It can generate substantial investor interest and potentially lead to significant fluctuations in the stock price. In comparison, an FPO typically has a lesser impact on the market as it involves the sale of existing shares and does not introduce a new company to the market. To summarize, an IPO is the first sale of shares to the public by a private company entering the stock market, while an FPO is the sale of additional shares by a company already listed on the stock exchange. Both IPOs and FPOs play important roles in companies' fundraising efforts and provide opportunities for investors to participate in the growth and success of these companies. Thank you all for watching. I hope this video helped you understand the difference between an IPO and an FPO. If you found it informative, please like, share and subscribe.